Good evening, good evening, good evening, good evening. What's going on, everybody?
And I was getting quite comfortable with the pre-webinar.
Hey,
Hi.
I'm gonna have to start charging for the music.
Nah, I can't do that. That's the whole time.
Happy Friday, guys. Everybody, welcome to our Friday night huddle. If you don't mind, everybody just start sharing where you're calling from and just say your name and where you're calling from. Let everyone know that we are located everywhere. Who do we have on the call?
Fabulous Mo, Lou
North
Paradise,
Carolina.
Cape May, New Jersey.
All right, what's going on, Lou? How you doing, man?
Good, my brother.
Good. Who else?
Carol,
I can't hear you, Sandy.
Denise Jenkins, Humble, Texas.
Denitris, how you doing? Welcome to our team.
Thank you.
Alita Turner, Sacramento, California. Yes, I am here, Mo. I am here.
What's up, Alita? Good to see you again. Good to see you.
Joseph,
Kenny Johnson.
We got Joseph Masterson from Florida. And who else do we have? Benny? Was that Benny Johnson?
Yes, North Carolina.
Hey, Benny. What's up, man?
Okay, you.
Okay.
I'm in this is G. I'm in terrible, horrible weather, California. You wouldn't like it here. Don't come.
It's coming to Sacramento. It's on its way tonight up here to Sacramento. So I got you.
Who else do we have?
in West Palm Beach, Florida.
All right, Florida representing.
Hey, Mo, Benny Miller, Newport News, Virginia.
What's up, Benny?
All righty.
Tara Cannon from Tampa, Florida.
Who's that in Tampa?
Tara.
My queen.
Birthday girl.
Who else do we have?
Hey Mo, I see I got some of my my teammates on this call too. My real estate teammates, Ronise and Shireen is on this call. So they're calling in from Sacramento too. They're probably a little shy, but I went on ahead and shouted them out. I sent out the text and invited them.
Right. Well, welcome to our call, guys. To the two shy ones. Welcome to the call. You don't have to be shy on this call. Is that it?
Thank you for the invite. This is Shireen from Sacramento.
Hey, Shireen. Glad to have you on the call, Shireen.
Thank you.
This is April March from Memphis, Tennessee.
What's up, April? Good to see you. Yeah, glad to have you on the call.
Thank you.
All right. I see Jill on here. Jill. Welcome to the call, Jill. Elvis. Welcome to the call, guys. Welcome to the call. I'm so glad to see everybody. Great. So we're going to go ahead and get started. More people will probably start trickling in a second. I don't want to take too much of your time up. It's already at 8:06, and we are recording now. So we want to welcome our guest speaker. He's our very own Gerald White. He's on the call with us today. Today we're going to get a chance to pick his brain so he can teach us a bunch of good stuff. How's your brain feeling today, Gerald?
It's sharp as a tack.
All right. All right. Okay, guys. So today we're going to be talking about innovative funding strategies. Before we get started, I definitely want to just send a shout out to our team, just to encourage everyone to keep on striving and keep doing what you're doing. I'm looking at the progress and the performance of the individuals on our team trying to get the word out, bringing in deals. Guys, you guys are doing a phenomenal job. Alicia's on fire right now. Alicia, good job for all the deals that you're sending in and the leads that you're sending in. Deantris is brand new to our team. I'm so excited about having her on the team. So welcome aboard. We've got a lot of new people that has been joining our team lately. So if you are new and you're on our team, definitely welcome, welcome, welcome. This is our Friday night laid back huddle, guys. It's just what it is. It is a huddle. You do not have to be shy to be on this call. This is where we get a little relaxed and, you know, we learn and we talk and we collaborate and we do all of the things that a team should do just to come together in one place to get our ideas out and to get our learning out. So this is the place where you can ask the necessary questions. Okay, so it's not real formal. Hey, Callie, good to see you on the call, Callie. So it's not very formal. Okay, but this is where we're gonna come and we're gonna do a bunch of learning and, you know, make sure that our team is nice and tight. Okay. All right. So with that being said, innovative funding strategies. Innovative funding strategies. A better word for that is creative funding. Okay, creative funding strategies. This is what we're going to elaborate on tonight. One of the reasons why I wanted to talk about creative funding is because as lenders, and especially solution-based lenders, which is what we are solution-based. We try to find the holes. We try to poke holes. Gerald always say all the time, I'm a hole poker. I like to poke a lot of holes, and you know, and the reason why I do that is because when you poke holes, you see where all the weak spots are. Okay, so we're going to poke holes and we're going to find out where all these weak spots are, where we can learn and where we may be messing up at. I told one of our reps today that when you're doing solution funding, all you have to do is come up with a creative solution to matching deals together. Most of the times it's simply clients cannot figure out the second half or the second piece to close the deal out. Something that they're missing, right? They may have the credit, they may have the financials, they may have the ideas, they may have the business plan, they may have all the pertinent things to go into the lenders and getting funded, but yet they're still missing the closing costs, or they're missing the skin in the game. They're missing what it's going to take to actually wrap this deal up, okay? And that's where a lot of clients get stuck at. You know, you may see a property that you can buy at $100,000 or so, but yet you don't have the $20,000 to close with. But yet there's $200,000 in equity in an equitable position on this property. So how do you get that $200,000 out and you don't have the $20,000 to close with? So that's where solution-based funding would come into place. What about a business that you're trying to get off the ground and you know this business is going to be phenomenal? You know it's going to do great, but yet you do not have all of the funding required to get this business off the ground. You know, you may be able to come to us and do a business acquisition loan, but yet you don't have the rest of the capital that's needed to close that out. Well, that's where innovative funding strategies come to play. So, and a lot of times people don't know exactly where to turn to. They don't know how to get that money, right? So, what is the meaning of innovative financing? Well, innovative financing refers to a range of non-traditional mechanisms to raise additional funds. Okay, so innovative financing, this is what we're doing. It just refers to a range of non-traditional, write that down. Innovative financing is a range of non-traditional mechanisms to raise the additional funds, right? So this is a problem, obviously, that a lot of people have when they're trying to close deals. They don't necessarily have all of the necessary funding in place to close the deal out. So guess what? We've got to get innovative here, okay? So the common financial sources that's used in developing economies can be classified into 4 different categories, okay? Family and friends giving you money, right? Maybe family and friends. I don't know if you guys have a lot of rich uncles and rich cousins and rich friends that you can pick up the phone and say, hey, Joey, can I get $20,000 or 30,000 or 100 grand or whatever it is, or to help you out. This is what family and friends are for, right, Gerald?
That's right.
No, not for me.
You paying me 100% back right now?
What about equity?
Joey's rich. Get it from Joey.
I was about to ask Mo for some money. Let me hold 50.
What about family? What about equity providers? Right, these are different ways to obtain this missing funding that's needed. Okay, equity providers, and then you have debt providers. Okay, debt providers, which is what we typically operate in. We typically operate in the arena of debt providers. Okay, and institutional investors. But our area is typically in debt providers, right? That's the business that we're in. Okay. Hey, Alan, good to see you on the call.
Thanks for having me.
Okay. So how do we create a source of funding, guys? How do we create a source of funding? Well, the very first way that most of us in business start out is what's called bootstrapping. That just basically means that you are organically bringing the money yourself. This is when you tap into your savings, tap into whatever sources that you may personally have to get the rest of the money that you need to close out a particular project, right? So bootstrapping is one. Loans, okay? Credit cards, okay? I remember a story where you guys know not Wesley Snipes. What's the guy's name? Somebody help me out. Spike Lee. Spike Lee, the movie producer. Spike Lee told a story on how he funded a movie using all of his credit cards. He didn't have capital. He didn't have cash. And so guess what he did? He rounded up a bunch of credit cards and leveraged the cards, right? And it worked. Credit cards is another form of lines of credit, right? Crowdfunding, bank loans, angel investors, right? Venture capitals, okay? These are different funding sources that you can utilize, most people utilize when they're trying to bridge the gap. All right, bootstrapping is the very first thing. I tell you, as a business owner, that's exactly what I did. I bootstrapped my way until I just had no other choice, right? So I leveraged all the money that I had. I remember when I started my first business, and it took me so long just to try to make 10 grand. And when I made that 10 grand, I took that 10 grand and I diversified it. Imagine that with 10 grand. And it was some years ago, until I was able just to really start flipping that money. Okay. So that's all I had in my name. I didn't have a rich uncle, what I did, but he didn't give me any money.
No?
No, he didn't. I wasn't able to take out loans at the time. I didn't have, at that time I didn't have credit cards. So you guys get the picture, right? You get the picture. There's different sources in different ways. Now, which creative solution do we tend to use here at Sequoia? What do we typically promote when we're looking for solution-based alternatives for our clients, right? Gap financing is what we typically talk about. How do we fill in the gap? All right. Gap financing covers a couple of different loans, whether it be a term loan or whether it be a line of credit. So gap financing is a term that you may refer to a type of loan or a credit line to cover the difference between the amount of existing loan and the total amount needed to complete the transaction. So if there was a transaction or a loan or a deal that you had on the table, and the only way that you can close this deal out was to utilize maybe credit cards or utilize a line of credit or utilize gap funding in order to get to your goal, would you do it? On everybody talking at one time, would you utilize that type of funding to get to your goal? If you needed to, if you needed to
Yes.
tap into,
Yes.
Yes.
right, you would leverage that, right? Now,
Yeah.
all I'm saying is that this is just one solution. This is just one solution. You tap into term loans and lines of credit. It's typically used when the borrower needs additional funding to close a loan, right? Okay.
Yes.
So, what is a term loan? You all hear that term all the time. Say this is a term loan. A term loan is one upfront payment that you're going to get from the bank. That's just one loan. It's just one lump sum. Okay, here's $100,000, and here's your payment. It's amortized. The word is amortized. It's amortization. That means that there's a close-in date. That means there's a start and an end date. That's what a term is. It's for a particular term, whether it's 5 years, 10 years, 20 years, whatever the term is, there's a start date and there's a finish date. So it's amortized. Okay. You'll hear that term in our industry all the time, amortization, or it being amortized. That's what term loan means. The lender provides the funds and you repay the loan with interest over the months or over the years. It's flat out, it's cut and dry. This is this is what you need. So a lot of people do use term loans in order to finish out or fill the gap. So if you're able to qualify for a term loan, you can utilize a term loan to fill the gap, right? Okay. So unlike term loans with fixed payments, we also utilize a line of credit or revolving loans. You guys hear that all the time, revolving loans. Or revolving loan has no established term. It is not amortized, which means money is withdrawn by your company, and then you're able to borrow from that. Okay. And then as you pay it back, it replenishes that line of credit and you're able to use it over and over and over again, right? So these are solutions that you can utilize, whether it's a term loan versus a revolving line of credit. Both fits the bill to being a solution to filling that gap. Okay, so revolving loans offer clients a revolving line of credit that can be tapped in for various reasons, right? What is the most reason that people will use a revolving line of credit? Flexibility, right? This is what all of you all on the call today, because when you hear lines of credit, people are drawn to lines of credit because of its flexibility. Because revolving credit allows individuals and businesses to borrow what they need and pay it back over time. So when you're playing the leverage game, if you could tap into money and not pay for the whole thing, the whole loan at one time and just pay for what you use, a lot of investors and a lot of customers like that option better, correct? Because they get to tap into exactly what they need. They may get $100,000 line of credit, but right now, guess what? They only need $50,000. They don't need the whole $100,000 at this time. And so then they're charged for what they're utilizing. Okay, so what are some of the lines of credit that's considered lines of credit? All right, credit cards, right? That's a line of credit. Personal lines of credit, right? That's just a straight out, line from the bank. Another form of revolving credit are HELOCs, home equity lines of credit, right? That's when you're taking out a secure loan against a property, against the equity, and you get a loan and it acts revolving, like a revolving line. You pay it, you get it, you pay what you're using it on, and pay back only what you use. I mean, pay your interest on what you use. Okay, so these are especially flexible with very little restrictions. This is another reason why investors and clients love lines of credit, okay? And then they love things like gap funding because it has very few restrictions on it, right? If you like, if you like me, you don't want people telling you what you can do with the money. I've got different things that I want to do with this money. I really don't want you to dictate what I'm going to do with my money. So this is why people want to tap into lines of credit or term loans. Okay, y'all following me so far?
Yes, sir.
Okay.
Yes.
All right. So what do I need to provide for a line of credit? Okay. Lenders will evaluate your credit worthiness using several measures, including your credit score, your loan repayment history, any business risk that you may have. It's a lot of businesses that's out there that lenders just won't even lend to. What do you mean business risk? Well, risky businesses. What's some of the risky businesses right now that you all think that lenders will not lend to or don't want to give you a line of credit or a loan on? Let me hear some of your thoughts on what do you think a risky business is? Because unlike, we're in the industry, but a lot of consumers don't know. They're just thinking, hey, I'm in business, I can get this. What? No, your company may be a business that's risky. So what are some of those risky entities?
Automobile industry.
Man, the automobile industry, right? Automobile industry. What else? What's another risky industry?
Marijuana industry.
The marijuana industry. Correct. What else? Somebody was saying cannabis. I heard you. Yeah, cannabis. Cannabis industry is risky, right? What about the trucking industry?
Yeah.
The trucking industry. That's another industry that's a high risk industry. That's just think about it this way. Someone in the trucking business trying to get funding right now, we might have to get them gap funding opposed to business funding because lenders don't want to lend to trucking companies, right? So we need to be able to give them something that has few restrictions.
The construction industry.
Oh my God, the construction industry, real estate industry, right? What's another one, G, that we have a hard time funding?
We got trucking, we've got real estate, really any kind of financial service is usually pretty difficult.
Investment.
Yeah, investment, consulting's not great. Music industry or entertainment, not great. And I'll discuss what we can do about that after we get through these slides as well.
Yeah. So a minimum of a 680 credit score is what you're going to need. Okay. A minimum of a 680 credit score is what you're going to need. All right. Now this is for your Nina. We're going to talk about the Ninas and we're going to go into, and G, you can jump in any time, but a minimum 680 score, no more than 6 increase. I actually want to change that to 4 increase. I'm going to change that to 4 increase. Keep in your mind, just change that to 4 increase, okay? Instead of 6. All right. 3 open active trades. What does that mean? That means that you want to have at least 3 open primary accounts. What does that mean, G?
So we're looking for not starter credit, right? You're going to have at least 3 open active trade lines. So that means like credit cards. Traditionally, we're looking for not $500-$600 credit cards. They need to be at least $2,500 limits on those cards. 2 of them or 3 of them preferred, and they've been open for a couple of years, so you have established credit history. Because a lot of times what happens is like when your kid turns 18, you add them as an authorized user on one of your credit cards and they have an 800 credit score, but that doesn't show the bank their credit worthiness, right? Because they don't have any history. So that's what he means by 3 open active trade lines. He's talking about established credit history.
That's correct. And also no new lines of credit or revolving accounts in the last 6 months. Why is that? Why no new credit in the last 6 months? It becomes a what? What's the reason behind that, G?
It's a risk, right?
It becomes a risk.
Yeah.
Right. It
Yeah,
becomes
they don't want to see that you have a brand new mortgage on there. You know, lenders will look at that and think, okay, is there trouble? Are they trying to get money to pay for that mortgage or pay off this debt? So, you know, lenders are looking at risk.
And not only that, part of that risk is that lenders will also assess that and say that this person can be spread too thin. Okay, he's got more credit available to them, and if we give them more credit, it might cause him to collapse because he spread it way too thin. So when you're looking at a credit utilization, the more credit that you have available, becomes an issue, right? It becomes an issue. It becomes an issue with your risk levels. Okay, so banks look at it in that sense. So you need to have a minimum of 2 years in business. Now, one of the things that we're running into is that people, a lot of people have, they have sole proprietorships type companies, or they're not in business, but yet they're looking for this type of credit. You got to have 2 years in business. This is business funding. So you got to make sure that when you're talking to your clients that they have an LLC, they have a C Corp, S Corp. They need to be in business for at least 2 years. Ideally, no more than 20% of your total available credit usage. You want to elaborate on that a little bit, G, because 20%, I know it's kind of like, some people are looking at 20%, and some lenders will allow us to have a credit usage of 40, 50%. Why 20%?
Well, I mean, again, this involves your credit utilization, like you said earlier, is about being spread too thin. This is a guideline, so it depends on the product, it depends on the lender. So obviously, the lower the utilization, the more likely you are to get funded, at higher amounts. If you have established credit and the utilization is low, you don't look like you're desperate, right? Someone that has 80, 90, 95% utilization would come off to the lender as, well, they're all maxed out. They've maxed out all their credit cards. They have no other option. And maybe that's why they need this money. It kind of leads to trouble. Again, there are some lenders that will work, in that 40 to 50% range, but ideally you want to be 20, 30% at the most.
Yeah, excellent. Any bankruptcies? Now, this is one I was going to leave this off the slide because, really we don't want any bankruptcy. Really, we don't want any bankruptcies. However, there are some lenders that will allow us to get away with the bankruptcy if it's 2 years and over. Okay. But let's try to stay away from the bankruptcies if possible. If you can find some clients that don't have a bankruptcy, that's perfect. But if they do, if it's 2 years or more, we still want to look at it. Now, the highest stated line of credit, LOC, which is line of credit amount, is per lender is 35 to 50K. This is stated, guys. Remember, we're talking about stated income, no asset type lines of credit. So the minimum, the amount that we can get is only 35 to 50K per lender. So we will use the same process that we use for gap funding, the capital stacking method, to obtain funding from various lender partners and helping the client to obtain its desired amount. So, G, if you don't mind, just, we want to just talk about this for a second because, of course, this is what everyone is here for. They want to know how much can a client get utilizing this no income, no asset module. I put it, for example, here on the next slide, that if a customer is looking for $100,000 under the no income, no asset funding program, what it would typically look like with the Nina. So this is where you can kind of jump in there and talk about how it's broken up, how the clients will be able to obtain 100,000, how clients are going to be able to obtain 250,000, utilizing no income, no asset. Because I'm sure people are thinking like, man, how is that even possible, right? So go ahead, G.
Yeah, I mean, obviously, the ideal solution is to go to one lender, right? You have one lender, one payment. But if you don't have provable income or provable assets, right? Let's say you're a startup, so you're pre-revenue, or you're in the first 3 years of business, you're reporting a loss, right? So you're unable to prove the income, for one reason or another. And when I say prove it, meaning tax returns, right? Bank statements, things that they're going to ask for in a traditional line of credit, because those requirements are going to be harder. They might do a 4506T, or which is a request for transcripts. As of a side note, as of July 1st, that's going to change to an 8821, but it's the same thing. So if you can't provide those, or your customer can't provide those, then we're going to have to basically piece it together, for lack of a better word, right? So we're going to need to, if we're looking for $100,000, we're going to have to go to a couple different areas to gather that money. So, one option is to go with a no asset, no income line of credit. Those line of credits are not going to be $100,000. Like Mo said, they're going to be $35,000. The interest rates are going to be higher on those as well. And then credit cards, right? So a lot of people will ask me, well, how do I get business credit cards for a company that's either newer, right? Doesn't have the history, or it just basically doesn't have the revenue. So, you got to look at it like this. So, when you were 17 years old and you went to go get a car, right? And the lender wouldn't, the dealership wouldn't give you a car, right? Because you're only 17. You don't have any history. So your parent, your mom or your dad, they co-sign, right? So they co-sign, then they give you a car. Essentially, that's what you're doing too. You're just co-signing with your personal credit. So to have the income, or without having the income, you can use your credit in order to get a business credit card, right? So we're going to be piecing it together. So if we need, $50,000 from one credit card, $40,000 from another business credit card, that's $90,000, and then maybe a $30,000 line of credit to get you where you need to be, right? Because you don't have the bank statements, you don't have the required documentation. You can see here on this slide here, Mo. You want to go over this? You want me to go over this?
Yeah, no, go ahead. I'm just, basically, of course, if you need more money, you're going to need more documents, right?
Yeah.
Is that the idea, right?
That's the idea. So you're what you're looking at here is for traditional line of credit, right? A 680 FICO, right? Not a Vantage score, not a Credit Karma score. They're going to go by a FICO, right? On Experian, all the bureaus. Now there's different lenders that take different bureaus, so there's some strategies there in terms of applying them. Maybe unlike real estate, maybe this lender only uses Equifax, right? Or this one only uses Experian. So same thing, lower utilization, no later collections, no bankruptcies, and less than 4 inquiries. But then if you look over to the right, this is the documentation on a traditional line of credit. Bank statements, typically that's going to be 3. It could be a little bit more. You're going to need an LLC or an Inc. At least 1 year in business. More is better. 1 to 2 years of tax returns. And then some banks require collateral for, usually for over $100,000. Collateral could be property. It could be accounts receivable, so that they could money that you're owed, right, from customers, or equipment. And then 4506T and 8821 are basically the lender requesting tax transcripts from the IRS to verify that you're profitable and you're making money. So sometimes the ideal solution isn't realistic, right? So we can't go to the bank and say, hey, we need 250,000 or we need $100,000. So, that's the reason why, we're having this meeting, with alternative ways to get money, specifically for startups and pre-revenue.
Yeah, yeah, and so I mean, just the documentation alone. So G, this is a great example of someone that may not necessarily, have the bank statement, right? They may not necessarily have a collateral, okay? And then, some people have not filed taxes, right? So, but does that mean you don't have a great idea, or does it mean that you can't leverage capital to make a great return on an investment and things of that nature? It doesn't mean that. It just means that you don't have what it necessarily takes that the bank was requiring to leverage money from them. So then the alternative is to do what we're talking about today, which is a no income, no asset type solution. If you don't, so this is what pan out at. The customers who don't have the bank statements, who don't have the collateral, who's not able to file the taxes, or who hasn't been, able to prove taxes. An alternative is the no income, no asset. And it's stated, okay? It is a stated loan. So this is why we're talking about. You guys can ask questions at any time, but this is why we're talking about this, because you all have you got deals sitting on the table, and guess what? You have clients. I'm working on some right now that just they don't have the closing costs. They don't have the 50,000. They don't have the 70,000 or 100,000. Would you think that a client would not utilize a NINA program to close out a deal that's about to render them a couple of $100,000 in profit? How many?
Can I jump in, Mo?
Huh? Yeah, absolutely. Anytime.
Most talking about leveraging credit, and these are guidelines, right? So, depending on what your client's needs are, if they need to access capital or they need money to start up a business, and maybe they're not, it's a new LLC, right? It doesn't meet the requirements, of a year in business. Maybe it's only a couple months old, or maybe it's brand new. There's so many different paths that we can go through here. So we could even leverage your credit to get them a little bit of money there, right? That would traditionally be a business credit card, right? So you're going to open an LLC. We're talking about maybe $50,000 to $75,000 only, right? And so what I would say to those customers that are trying to open up a business, we talked about industries earlier, right? Restricted industries. One thing that you're going to do if you're opening a brand new LLC or a brand new Inc. and you're trying to get funding for that business, whether it be immediately or 2 or 3 years from now, is you want to keep restricted industries out of the name of the LLC.
Right.
You don't want to say that this is, I'm just going to use examples, Alpine Realty or Apex Transportation and Logistics.
Right. Exactly.
Even hot industries like IT, right? IT is a really great industry right now, but you don't know. I mean, in 2 or 3 years, there could be another .com bubble burst. And now ITs can't be funded anymore. So, use your kids' names or whatever you want, but just obscure that name. So then you the chances of you getting funded are much greater. This is a mistake that a lot of people make, that you would learn from, right? You have a history of an LLC. It's 7-8 years old, but it's got logistics or construction in the name. All of a sudden, you're not fundable. So there's six years of history down the drain.
So can we use that? We can use the NINA for those industries, though.
Yeah.
Right.
So restricted industries. Let's say there is construction in the name. We can go after credit cards, maybe some of the smaller lines of credit. But even if you have the assets, you're most likely not going to qualify for a traditional bank line of credit if you've got construction in your name. Even if you're making a lot of money and you can prove all of your assets, because those restricted industries, those SIC codes, the banks look at those and they're very particular about those industries. So instantly, if you're in construction and you have construction in your name or transportation or trucking in your name, you're high risk, regardless of the amount of money you're making.
Absolutely.
I have a question. I don't know if I got lost or what.
Okay.
So, so for the Nina, you know, number one, what is the requirements? And number two, they have, so they have to apply for a business credit card, or are we funding them?
Both. So again, if you go back to the previous slide, Mo. So for the Nina, we're gonna put it together through a few different products. Smaller lines of credit, right? $35,000, $50,000 lines of credit, and some business credit cards, right? And there's ways to cash those out if you need cash. There's services that will liquidate credit cards, or you could just utilize them to start up the business. But if you need $100,000, $200,000, and you want it to come from one lender, that's going to require documentation. So, you know, there's no lender is going to give someone $200,000 without any documentation, right? So this is one of those things where for a startup or someone that's pre-revenue, there's only so much that you can do. Getting them $150,000 is doable, but it's going to take a couple smaller lines of credit to get there, and maybe a few business credit cards that either they could liquidate, get cash out of, or utilize those credit cards for, you know, to start up the business, because obviously a lot of companies and a lot of vendors take credit cards. So
people come to me and want to know about the Nina. I let them know they have to have some type of business credit cards, right?
no, we're talking about getting them business credit cards. The requirements for getting a Nina are almost strictly credit based. 680 credit score, under that 20% utilization. You know, they have to not have starter credit. As far as documentation, they need an EIN, articles of incorporation or formation documents, and a driver's license.
So
That's the only requirement.
We're helping them get the business credit card.
Yeah, and lines of credit. Yep.
Okay, I thought they had to have it, you know.
No.
All right.
No,
So
that's what we're providing.
Yeah, that's what we're providing, and the lines of credit. So even if they just get a traditional line of credit at 50,000, we may be able to get two of those from two different lenders. So they'll have two different lines of credit so they can reach the $100,000 that they need for whatever their project is. Or we may do 50,000 in a regular line of credit and another $50,000 on the credit card. Same thing, they still have access to $100,000. But this is, like I said, this is for people who cannot necessarily prove the taxes or prove the income, right?
like Brother Toby, right? The one.
Right,
like
exactly.
Okay.
So if they can't prove these things here, if they can't prove the bank statements, if they can't prove, you know, their tax returns for 1 or 2 years, or they don't have collateral over 100K for over 100K type loans, like property or, you know, equipment or things of that nature, you know, and they can't do a 4506T or 8821, then their option is a no income, no asset program, which we've got to piecemeal it together. We've got to give them 50,000 line of credit, you know, with no income, no asset stated, maybe another 50,000 with another line of credit, depending on the lender, or a credit card. But
they got to come in with some funds, though.
Yes. Say again?
Okay, it's not 100% funded. They got to come in with some funds, right?
No. They don't have to come in with anything. This is the funds. So let's give you an example. Someone's buying a property. You're in the real estate industry. They're buying an investment property. And this investment property is $100,000 to purchase.
Wait a minute. Let's go California. 300.
Okay, California. It's $1 million to purchase. So it's $1 million to purchase, right? Let's say they need 20%. They need 20% of the 1 million, which is what? 200 200,000, right?
Uh-huh.
So they need 200,000 to close, but they only have 100,000 to, themselves. We talked about the bootstrapping. They got 100 grand themselves, but they
Okay.
need another 100,000. Now, unless they got a rich uncle, rich cousin, rich family members, or they have access to getting more capital, sometimes they've got to utilize a program like the no income, no asset program because they don't have these necessary things. So if they do have these things, we can just get them gap funding. If they do have the bank statements, if they do have the tax returns, if they do have collateral, we can just get them traditional gap funding.
Okay.
So this is geared toward the people who cannot prove these things, but yet they still need $100,000.
I'll give another scenario, Mo.
Go ahead.
Well, let's say you have a client, right, and they want to start up a business, okay, and they clothing business, and they need $50,000 to buy inventory, merchandise for the startup. They're pre-revenue. They just started it. They literally just opened the LLC a week ago. So they're not going to qualify for a line of credit, even a small one, because they haven't been in business long enough. But a business credit card, they could qualify for. Now, the way the business credit cards work is typically there's 0% interest for 12 months, right? So it's really great to be able to tap into this. So
yeah, let's talk about that.
We open an LLC, they open an Inc. Okay, a week or two later, they need to go out and get a bag, right, to buy the inventory that they need. So we get them a business credit card utilizing their credit, their personal credit. You're going to have personal credit. If you don't have good personal credit and you don't have revenue, you're not going to get a loan from anyone. So if they have the credit, but they're just starting up, they won't qualify for a line of credit, but we can maybe get them a $50,000 a business credit card, maybe even another one for $25,000, right? That's going to cap out around $75,000 if it's a brand new LLC or Inc. That has no business history. So there's a lot of different avenues, that you could tap into. Startup money is a really popular thing. I started up a business, like Mo was saying earlier, in 2007, which turned out to be terrible timing on my part. But I maxed out all my credit cards to get that business open. A lot of people, that's what they do. Business credit cards are great because they're traditionally higher limits, right? You go to Best Buy, you get a credit card, through Best Buy, and it's, personal credit card, it's $3,000, $4,000, $5,000, right? There's only so many flat screen TVs you can put in your house. The business Best Buy credit cards for the same person are $15,000, $20,000 because you got to buy laptops, for your employees, you got to buy printers, you got to buy all this stuff. So business credit cards are traditionally going to be in that $25,000 to $50,000 range per card. So if you have customers that need startup money, that's a great way to get them.
Time for like when they apply and get approved, usually how long does it take?
We say that you get a pre-approval within 1 day, and then from there, whether it's a line of credit or a business credit card, typically it's 2.5 to 3 weeks.
2.5 to 3 weeks
before you actually get it.
Right. Yeah. Before it's like in your bank, in your account, where you have the card in your hand.
The actual approval process is pretty quick.
Yeah.
We're talking a couple of days.
Okay.
Yep.
For the approval process.
Credit score, 680 at least, 680 and higher.
680.
680 credit score. Lower utilization is really important, right? So if you submit a client, and we're going to talk next week about qualifying customers. So for those of you that are on this call, don't miss that call because this is going to save you a lot of time. But it would be to qualify your customer. So we want 680 plus FICO. Don't take credit karmas and things like that. Can't be a Vantage score. It's got to be a real FICO score. Lower utilization, right? 20% or lower, ideal. And no recent lates, no collections, no bankruptcies preferred, and not very many inquiries. Like we said, 3 or 4, right? If you submit deals that don't have those requirements, let's say they have a 680 FICO, but utilization's 60%, then we'll get an answer pretty quickly within a day or two, and we'll submit back to you, hey, they need to pay off these cards in order for them to qualify for this.
Right, right.
Will this be on, added to our website as one of the options?
Alan?
Hey,
So we're gonna add the line of credit to the gap funding portal. I think we should keep it in on that same portal.
Yeah.
That'll be Alan's call on that. Okay. But here's the good news. Commissions, right? This is the good news. So you still get paid the same amount. Okay, it's 20% charged to the client. It's 20% on the back end charged to the client. 15% covers underwriting, processing fee, and the broker's fee on the lender side. Okay, that covers it on the lender side. That doesn't cover our side. 5% covers the referral from us coming from us. We still pay you out 4%, and we're keeping 1%. Okay, of that 5. So 4% still goes out to you. So on $100,000, you're still making $4,000. So utilizing the note.
They off of 100,000, the client's being charged 20%.
That's correct.
Okay.
They're being charged 20% for expedited on the back end, and it's 15% if it's not expedited. Okay, the same rules apply.
How's the rates looking? How's the rates? Is the rates? You said the rates are high, right?
I'm gonna actually discuss that after this slide. I'll break down all the rates for all the different products we're talking about.
So that's the good news here. So we're still getting paid the same amount that you're getting paid on gap funding. So when you guys got customers, and let's look at it. This is how you get paid twice, right? Because you now have customers that's trying to purchase a property. You're going to put them in for the funding for the commercial property or whatever it is, and you're going to get paid from that. But then you're also going to put them in for the second part of, which is the gap funding part, the NINA, okay, or the gap fund, however you want to do that, and you're going to get paid from that. Okay, so now you can see how putting together a deal like this, you can make $4,000, $5,000, $6,000 off of a deal by putting together a kind of like a secondary loan to help them with the closing costs and closing and bridging the gap.
Okay. Mo, a quick question.
Sure.
So Alicia said 10 days under 20% on the back end, 10 day and over 10 days 15%, but that's not going to apply for this type of funding because it's going to take 2 to 3 weeks even at the fastest. So what's our breakdown on expedited on lines of credit and business credit cards versus the regular gap funding, because it's going to be a little bit different.
So as it relates to the for the NINA loans,
commission, yeah, I'm talking about for commission, right? So on a regular gap funding, we have expedited, that's 10 days, right? Anything over 10 days, we only charge 15%.
right?
This product's different because it takes 2 to 3 weeks minimum, even at the fastest.
Well,
whether any of the products.
Yeah, so it's not going to be. It'll be the same 20% on NINA because the difference is that the 2 to 3 weeks is them actually receiving the card. Once we get the approval for the NINAs, that's within the 10 days. We're going to keep our prices, keep our commissions the same.
Mm-hmm.
Now traditional gap funding, they actually get the money right away. It'll go into their account right away. So
is there an application fee, Mo?
Say it again.
Application fee, like with the church funding, they have to pay like with the 800 or something.
Yeah, there's no application fee.
Okay.
What's up, Joey?
Question, with this funding here, for as far as the auto dealership goes, auto dealers, use floor plans a lot to buy vehicles. So if we're able to give them a line of credit, would that be something that they would do, being they're an auto dealer?
Yeah, for an auto dealer, this could work out really well. So auto dealers tend to be a harder industry to fund, right? And at some banks, that's a restricted industry. So we definitely would have to get some creative financing, in order to fund them. But just speaking the other day to the gentleman that you had me speaking to, Joey, I forget his name. I think it's lucrative. Yeah, it's lucrative for an auto dealer to go this route because a line of credit's probably, in fact, is going to be cheaper than what they're paying on their floor plan for an auto dealer. The key is going to be on how much money they need, right? So unless they're doing $1 million or more a month, they're probably not going to hit in those high, $100,000 to $200,000 lines of credit. So that's going to be the sticking point there, is just how much they need in terms of the amount to make it worth it, right?
Right. Which I know a lot of the floor plans give them between 100 to a quarter.
Right. So, I would say for something like that, I would probably start with something smaller, right? Maybe not completely get rid of your floor plan and build history with the bank, and then with the idea of eventually increasing that line.
Will they increase that? As I asked you, if they will increase it, if they see a dealer and they're buying and flipping, and they're going through $1 million a year on paying it off.
Absolutely, they will.
Okay.
Yeah. Yeah, and I'm gonna break down. This is a good kind of segue. So I'm gonna break down. Essentially, we have 3 products here to keep it simple. We have a traditional bank line of credit. We've got a Nina line of credit, and we got business credit cards. Those are the 3 things that we're talking about here. So with the traditional line of credit, that's the one they're going to need documentation, right? They're going to need taxes. They're going to need bank statements, that kind of thing. The way that these lines of credit work, Mo mentioned this earlier, so they're flexible. They're going to give you an amount of money, and for argument's sakes, and just to make it easy, we'll just use round numbers. So say you have access to $200,000. Your line of credit at the bank's $200,000. You're only going to pay on what you take, right? So it's sitting there ready for you to take it. You're only going to pay on how much you take. So if you take $100,000, that's $100,000 in cash that's going to hit that bank account, and you can utilize that in really any way that you need to, in order to help the business, because you're going to have access to cash, right? So you could pay vendors, you could use it for a build out, pay employees, whatever you need to do. The $100,000 that you take out, that's going to have, there's not a term limit, but there is a maturity date. And this is important. So the maturity date is typically 3 to 5 years. Another word for maturity date, which, we don't like to say this word, but I'll just say it, is balloon payment, right? So it's a bad word, but you probably don't want to say that to your customer. That's why they come up with maturity date. It's like in real estate. It's not small, it's cozy, right? It's just another, it's a good salesperson word. So as long as you have the principal of that line of credit paid back before the maturity date, then you're making good on your loan. So every month you're going to pay an interest only payment for as long as you have that money out. So in the example of taking out $100,000, the payment, it depends on the lender, but it's going to be somewhere between $700 and $900 a month, interest only, right? That does not go towards the principal. So essentially you're paying to have that money out. So, customers get confused. They think, oh, I've been paying on this for 4 years and I've been paying $1,000 a month. So how much do I owe now? Well, the answer is you owe the full principal. So if you can make payments to principal whenever you want, and then that becomes available again.
That's right.
So, and each time you draw, that's what they're called, draws, that in itself is it kind of its own loan, right? So if you draw $100,000 this month, and then 7 months from now you draw another 50 because you have a $200,000 line of credit, the maturity date on the first loan is the term of when you took it out. And then the new draw that you took has its own term, right? So, and then if you pay it back, it becomes available again. So that's the traditional line of credit. A NINA loan works similar. The only difference would be is the requirements and the amount of money that you're going to get. Instead of getting $100,000-$200,000 in a single line of credit, you're going to get maybe 35 or 50,000. That there's no difference in how it works. The interest rate might be higher though, right? Instead of, they're usually about 6 to 12 points above prime. So you're not going to get the best rates. They're not crazy rates, but they're not going to be as good as a line of credit where you can prove your income and your assets. And then lastly is a credit card. The business credit cards are great. They're going to have a 1 year, essentially teaser rate, 0% APR for that first year. After that first year though, those rates are going to go up. So typically they're between 15 to 22%. So that's your cost and the way that these products work.
Can I jump in there, G? Also, just with that being said, just to piggyback off of that, a 0% interest for 12 months to an investor is music to their ears.
Yeah, I'd say if you can't take that $30,000 or $40,000 or $50,000 and flip that in 12 months, then we're probably not talking to the right people, right?
Right.
I mean, so yeah.
So keep that in mind when you're selling this, is that you're getting this money for 0% interest for the first 12 months if we get it on utilizing it on credit cards or what have you. So this is a way for them to become more profitable. We want to sell benefit, okay? Once again, this is creative financing. This is creative, innovative solutions. We want to sell the benefit of doing it this way. The benefit of obtaining a no income, no asset loan is that you'll be able to leverage that money for at least 12 months without any interest. Okay, so now from an investor standpoint, that's just music to my ears. What do you mean? I can get $100,000? Yeah, if we go this route, I mean, for 0% interest, yes, if we go this route. You don't think anybody would want to pay you money on the back end like that and 0% interest? Of course they will. Solution based, and you can come up with this $100,000 from me in 10 days. You better believe they're going to want to pay that money. Okay? Absolutely they will. Come on, guys, take your mics off. Let's ask some questions here. It's 9 o'clock.
Me again.
Hey.
So the 100,000, you said the 20%. So if they're getting 100, they need 100,000. So actually they're getting like 120,000. Is that it? Am I reading that right?
So no, I mean you're doing it right, but if they need 100 grand to clear, if they need to clear $100,000, then yes, we need to go above getting them 100 grand.
And that would,
Hey,
okay, that
Joey, get out your calculator and tell us how to back out that amount.
Well, on 100 grand, they're gonna get 80,000.
Right.
They need
No,
to clear
but what would it be if they need to clear 100,000? You need
about
to back out the
120
sales tax.
Yeah, about 124 off the top of my head.
Thanks, Joey.
Thank you.
So
Go ahead. I'm sorry.
and that's
I didn't
okay.
mean to interrupt.
I just want to throw that in there. What do you guys think? What's your thought process on this? Is this something that you believe that you can utilize, leverage? This is not for your big players. This is not for your big players and big customers, that needs $400,000-$500,000 line. This is not, they need to come with documentation. This is for some of your smaller, situations where they only need 100 grand. Maybe they need 150,000. Maybe they need 200,000. Stay within that range. Okay. Anything after that, these people need to come up with some documents.
you know.
Yeah, I would say you probably have more customers that fall into this category, right? I mean, well, it would be great if you had a lot of big fish, obviously, but you're going to have a lot of people, or I know I do, that come to me and say, I need startup money. You know, no one's going to give me money, or I don't have, you know, I'm not doing $150,000 a month in business transactions. So, you know, this stuff adds up. It can be very lucrative.
What
Go ahead,
about
Joey. I'm sorry.
Complains about giving up 20 grand?
huh? So
Nobody complains about paying 20 grand?
absolutely not. You know why? Because when you sell, and that's an excellent question. When you're selling them the benefit, okay, Alita, I know the 20 grand off of the 100,000 may sound a little excessive to you. But what we're utilizing is our capital stacking, platform and our relationships with, these banks. Now, I understand that you can't deliver the bank statements, the necessary bank statements that's needed, and you didn't need a chance to file your taxes, and you can't prove the income, where we can put you in a traditional loan. So what we're doing is leveraging our relationships with lenders that will give us this money without you having these things, okay? And just state it. So now you got to know where to go and how to get those loans. So because we have these relationships, and we can get this done in an expedited time, because remember, you're getting $100,000 is going to make you 200 grand, and we're doing this in 10 days or less. Okay, and for that reason alone, wouldn't it be worth for you to pay the fee to be able to make $100,000, to pay that 20% fee on the back end to get you $100,000 in your pocket, and to get you this money within an expedited time, because you said you only have so much time to close the loan? Would that be worth it for you?
Absolutely.
Absolutely.
Hey Mo, I was gonna say something. I honestly, if that line of credit on the race, even at the 20% charge for car dealers, that's gonna be a lot cheaper for like the smaller dealers than using the floor plans.
Yes, absolutely. We were just
Because
talking
I
to
know the
someone,
rates
right?
that they pay, and you gotta pay lot fees and everything else every month, and then they charge you 11% on top of it.
Absolutely, absolutely. Hey, Elvis, go ahead, man. What's up, Elvis? Elvis, take your phone off of mute.
Hello there.
Yeah.
No, we can hear you. Yeah, we got you.
We can hear you. Go ahead.
Yeah, this seems like it'd be something that's great for food trucks, right? That'd be
Yeah.
correct.
Say it
Yeah.
again.
Oh, yeah. Yeah.
Yeah,
Food truck would be great. Yeah.
Yes.
That's a
So I just sent a deal over to Ellen about 2 months ago. I had to find out Oklahoma. They don't have a food or restaurant background. They wanted to get started. They did have a co-signer that they could use, but they really didn't want to. And so we try to figure out a few things, but there just wasn't proper documentation of history and profit loss, etc. So I just eventually we just had to turn them away. They began to cook out the house, and just start a small following, and they're capturing a little attention, but still not enough to get a food truck. So
Yeah.
I've been leaving them on the back burner, trying to see what else I can find, and
There
this
you
sounds
go.
like a great opportunity.
Absolutely.
Give me some advice on where to how to approach this.
You know what? Just call the customer up and say, I got a solution for you. Send out the email to myself or Gerald, or send them the link. What I would say, send them the link for gap funding, and just in the notes section that they can place that they're looking for the no income, no asset. Send us the information, and let's go ahead and get them processed. And I'm glad you brought that up, because it also puts me in the mind of the investor that's trying to buy a property that's under $100,000. Well, we know that that the lending industry won't allow you to fund a property under 100,000. The loan has to be 100,000 or more. So what about those clients? They find a property, they see a property that's $80,000, $70,000. They have to buy that property in cash. So now we're talking about making people cash investors. What about the people that want to be cash investors? Right? You want to become a cash investor and buy a property because the lender is not going to allow you to do that under 100,000. We have to have a $100,000 loan in order to process that. This is where this loan comes in. Now you get the Nina, okay? And you
Hey,
can
Mo,
utilize that.
I just want to digress real quick about what Elvis had said. The biggest thing for you when you speak with them, if you don't already know, is determining what the credit is, because they don't have the documents, they don't have the provable assets. They're going to have to come with the credit. We can help, but they're going to have the credit. So if you pre-qualify them and you don't know what their credit is, or they come back and they say, oh, it's only a 600, they're going to have to go into credit repair or build up the credit or whatever before we can help them. So that way, you're not wasting your time, putting them through and giving them an application and going all the way through the motions to find out that they don't meet the credit requirements. That would be the biggest thing.
Okay, and what number is that?
680. We're gonna need a 680 FICO. You want that utilization to be low, 20% or under, I would say, for this particular business. And they not having starter credit, right? So ask them, do they have at least 2 trade lines, primary trade lines, not authorized users? So that would be credit cards. And are those, credit limits $2,500 or more, and have those credit cards been open for more than 2 years? So those questions right there are gonna tell us if if they can qualify, given the fact that they don't have the the provable income. I put my email and I put Mo's email in the chat as well. So for anyone who wants to take that down, if you have questions, you can always email us.
DeAndre,
The 20% under was what?
20% on the
What was that called?
utilization. On the utilization. Yeah, that's just how much credit they're using. So, if they have, $50,000 worth of debt, or you're going to want to make sure that they're under 20% of their total credit is being used. You don't want them to have 50-60% of their credit cards maxed out. They won't qualify for a no income, no asset, either, whether it be a line of credit, small line of credit, or a business credit card.
Yeah.
Okay, got it. And even though they don't have income for that particular business, what are you looking at their personal income and things, right? For this?
Yeah, it's just going to be stated. So you're going to state your income. So for business, you're going to actually state it. It'll be on the paperwork. What are you bringing in? And it's going to be based off of that number.
Yeah.
Okay.
So, but they're not gonna verify, right? So I'm not telling you to put fake information on there. We're not saying that. But what we're saying is that they're not going to have to prove their taxable income. Let's say if they're pre-revenue, or if maybe they're at a loss, right? A lot of businesses, at least in the first couple of years, even though they made money and they can afford their loan, they're not stating their profitability. It's a loss. Everything's a loss. Someone asked, Callie asked, the most they can get is 100,000. Well, you want to answer that one?
They can get more than $100,000. However, it's going to be broken up. The max that they probably could get is roughly around 200, maybe 250 grand, but it's broken up. Okay, so it'll be multiple loans. Okay, so just based on their credit and based on their the income that they're stating that they're making, and they're under that 20%. We remember we're using the capital stacking method. We're using
if they have documentation and they have revenue, and they can prove that through tax returns, bank statements, then lines of credit can go up to $5 million. Obviously, even with provable income, the lower amounts you take, the less due diligence the bank's going to do. So, you may have to give tax returns. You may have to give bank statements for larger lines of credit, but even under 250,000, they may not pull tax transcripts from the IRS. They may not do asset verification, but they'll still have to provide those documentations. If we're trying to get larger lines of credit, from one bank, right? Not stacking it.
Yeah, guys, we're losing people right now. We're going over the hour. You guys know we can talk about this all day. Deantranis, go ahead. You had a question. What was
No,
your
I'll get back with you because we previously discussed this a couple of weeks ago with my cousin and her fiance want to take over that little neighborhood bar,
Okay.
and with and with him needing to get the LLC because she has the business experience and a LLC already for her events planning business, but this is something that she wants him to do on his own. So we were trying to look for ways to do that, and what would be, the best way to get it done.
Gotcha.
We
So
need to
we'll
get
discuss.
we need to get it done.
Great. So we'll discuss that on our one-on-one call, Deanna,
Okay.
okay? When we do
On
our
Monday.
one-on-one.
Okay.
And also for everyone else on our team, I've been doing one-on-one calls with everyone. So if I have not had an opportunity to do a one-on-one with you, please inbox me. Let me know that you need to get your one-on-one done. That way we can kind of go over what you got going on in your pipeline. We want to make sure that you are you're up to speed on everything, and then I'm up to speed on what you have going on in your pipeline. I want to make sure that each and every one of you are successful at your lending practices. Okay, so this is why we are on these Friday night huddles. We do this as a family, as a team. This is the place where you can, what I always say, this is where you want to ask all of your crazy questions, things that you don't want people to know that you don't know or whatever it is. You come right here, and this is where you're going to ask those questions so we can better equip you when you're out talking to clients, okay? So with that being said, if there's no more questions, we've gone well over the hour, 20 minutes over, which means that this is some great information and you all are receiving it. But I want to definitely be respectful of your time. I think Alan is on a call. He had to hop on the call. Alan, if you're there, you need to say anything, please let me know. But I believe that he had to hop on a call for a brief minute. Okay. With that being said, G, did you have anything else?
No, I think the call's done. I mean, if people want to jump off, that's fine. Don't think you'll offend us, and I could stick around if there's any other questions. If not, we can end it here.
Excellent, excellent. Well, that's gonna come to we're gonna come to a conclusion of our Friday night huddle. Once again, I want to thank each and every one of you all for making this call. And I see our regular faces every week, time after time, week after week. This lets me know that you are dedicated to making your commercial lending a success. Remember to keep pushing and to stay encouraged. Don't get discouraged in this journey. It is definitely a journey, and with all the ups and downs and all the lack of deals sometimes that you might lose, with all of those things, just remember to stay in the game. You stay in the game, don't quit, stay in there, and don't give up. And I promise you, it will be a successful journey for you. Okay, there's a lot of money to be made, a lot of people that need to be helped, and you have the right team, you have the right people to do that. With that being said, guys, listen, until next week, we're going to be talking about actually pre-qualifying customers and pipeline growth. So you want to make sure you're on a call on next Friday as we show you how to properly pre-qualify these customers and grow your pipeline. With that being said, you guys have a good evening Friday night, and I will see each and every one of you at the top. Wings up, guys. Keep on going higher.
Thank you.
You're welcome.
Bye.
Thank you. Good night.
Bye.
Awesome call. Good night.
Good night. Thank you.
Thanks, Tara.
Don't forget to let them win.
That's right. Let's make them win. We're winning.